So, good afternoon and welcome to our specialist buy-to-let lender session. I'm delighted to say that I'm joined by two heavyweights in the buy-to-let mortgage market to give us their current view on current events in the market and to answer some of the questions that landlords have been sending in to us. So, a couple of introductions. Our first guest today is Adrian Moloney, Group Sales Director at OneSavings Bank. Adrian has been in the industry for, I think it's over 21 years now, Adrian, with roles at Building Society, Mortgage Trust, nationwide, before taking the sales director role at OneSavings Bank. Adrian was heavily involved, I think, in the merger between OSB and Charter Corp Financial Services. And as Group Sales Director, Adrian's now in charge of, I think, 3 specialist lenders:
Correct,
in Reliance, Precise Mortgages and Interbay Commercial. So it's great to have Adrian here with his experience in the sector. Adrian's also a highly respected industry spokesman and keynote speaker, it says here, and was named Mortgage Personality of the Year in the Mortgage Strategy Awards in 2018. So welcome, Adrian, and thank you for giving up your time today.
Good afternoon, Steve.
Thank you. Talking of experience, our second guest is none other than Mr. David Whittaker, CEO of Keystone Property Finance and Group CEO of the Property Business Group, which includes Mortgages for Business. Many of our viewers will know David from his MFB days, which he set up some 30 years ago. I think it is this year, David.
David this year, 30 years.
David's been specialising in the complex end of buy-to-let ever since. Known as a colourful figure in the industry, David's renowned for telling it like it is. Don't I know it? And is a regular commentator in the national and trade press. And like Adrian, David was also voted Mortgage Personality of the Year in the Mortgage Strategy Awards, I think a year before Adrian in 2017. And in 2007, David set up Keystone as a lending brand. And I think it was 2018, became a fully fledged specialist buy-to-let lender. A sort of poacher turned gamekeeper, I believe is the expression. So welcome, David. Many thanks again for taking part today.
Thanks, Steve.
So I'm conscious of time and we've got a few landlord questions to get through, but I thought I'd just be good to kick off with a general question of how you guys have had to adapt your business during the pandemic. And so what challenges you've faced in serving your clients. So maybe Adrian, you can pick that up first. How have you found things at OSB?
Yeah, I mean, like everyone else, we've got the vast majority of people in our business remotely working now, Steve. About 75% of our workforce, which for a sizable bank like OneSavings Bank, and in a very quick period of time, was quite a move. And that sort of coupled at the same time when the announcement came out about the mortgage payment holidays, or I'm sure we'll debate them later, more the mortgage payment deferrals. Came into play. So as you're trying to get people working remotely, we had to deal with an influx of inquiries on that and sort of move people around operationally to help deal with the queries for our existing customers. Whilst obviously, I think like everyone, looking at the priority, which was maintaining the safety of the staff of OneSavings Bank and getting them working remotely. So that came with its own challenges, but we dealt with that quickly. One of the biggest challenges for most lenders in the specialist mortgage sector, particularly in buy-to-let, was the use of physical valuations, which I guess came to a grinding halt. And we were fortunate enough we've got a very good proposition team to be able to react quite quickly during that time and bring out a limited offering around desktop valuations. Obviously, we've now seen the return of physical valuations, and we've been able to get our product set fully functioning now across all our product lines. As you said earlier, we run a multi-brand strategy underneath the OSB umbrella, and all of those lines now have a product offering focusing primarily on our core markets, which includes buy-to-let. So that's all out there now at the moment. I think the really impressive bit has been, not just for our business, I'm sure David will come on and be able to tell you what's happened at Keystone, is that, this time around, the mortgage business did not come to a grinding halt. Applications were still processed while the relevant information was in there. And actually, importantly for clients, things like completions, whether that was refinances or indeed some of the purchases during that period, which were allowed, still continue to take place. So I think we're, whatever it is, 10, 11 weeks into this now, and we're starting to see early signs. I don't know if normality is the right word, but early signs of getting back to some form of business processing and seeing transactions go through with the return of those valuations.
Yeah, it's a new normal, I think they're calling it, aren't they? Yeah. Well, David, have you had similar experiences? How have you found it?
Well, we differ slightly from OneSavings Bank in a key respect I'll come to in a moment, and well done to Adrian and his colleagues keeping going with AVMs, which isn't our available route to continue. But like many of your landlords, Steve, we all have a business continuity plan, and you dust it off occasionally, you play with it, and you congratulate yourself on testing 1/10 of it. But when you have to do it for hard and fast in reality, there's a few nervous moments, and we did actually test run it 2 weeks before we went into hard lockdown. And I think you'll agree with me, because you looked at MFB, it kind of mostly worked, but we didn't do it 100%. So we went into total lockdown on the 17th of March. And then we reached out to our respective IT departments and said, and boys and girls, that includes you. And they went, oh, really? Oh, yes, it includes you as well. So I think by 5 p.m. on the 17th of March, all businesses were in 100% in lockdown. Now they're having people go back into the offices to do health and safety checks and run taps for Legionella and all that sort of stuff. We've stayed away from the building since then. I think a couple of things that have changed for us, and we will stick with, and I'm sure Adrian will echo this as well, independent legal advice for directors of limited companies makes up 55% of my book. It's a high figure for OneSavings Bank. They're renowned experts in it. We now do that by video call. That's a win. I think we used to get about 80% of our documents electronically for completion. We now get 100% of our documents electronically for completion. And there's no reason to go back from that.
Correct.
So these are all wins that we wanted to do that are now had to be done out of absolute necessity. So I think that's all good news. But as Adrian's already alluded to, valuations stopped on the 23rd of March. So our world stopped. You either had an offer or a valuation report was going to come back the next few days, we could get you an offer out. But you had a whole chunk of business that was being worked on that couldn't get past the valuation point. So that has only come back to us since the 18th of May, and no doubt you'll challenge us on that shortly. So we focused our efforts on getting the stuff out the door. So funny enough, in April and May, we've had some of our best completion months ever, as we threw all of our resources at helping our landlords who've got cheap rates of offer from us, and indeed cheap rates of offer from OneSavings Bank, get those over the line. Because I think, and you may challenge us again on that later, I think there'll come a time where what we're looking at today will be a distant memory for people, and they'll wish they took rates in 2019 and 2020. So we've had a slightly different journey from Adrian, because we didn't take AVMs. We can't. We're a non-bank lender. Non-bank lenders don't like AVMs. We can't write it onto our balance sheets. So we had to wait until the 18th of May when valuers were let loose from the pen again, and they've been out in the field. And we're now starting to see that process picking up again for us. It's 10, 11 weeks. We've had the end of the beginning. Is this now the beginning of the end?
Yeah. Yeah, no, thanks for that. And I think all businesses across the country are looking at different working practices going forward. I think we've all learned a lot, haven't we?
Well, I think if you look at just like what we're doing now, Steve, the use of I guess visual communication is going to grow. I'd echo David's point in terms of the legal process. I actually think the legal process has held up really well during this time, and I thank our legal partners for that, because they are a very important I guess cog in the supply chain, and they've managed to get deals over the line, get them completed, and keep the supply chain moving over the last 10 or 11 weeks.
That's good. I mean, you mentioned earlier about the government stepping in with various sort of support packages, including the call to lenders to offer mortgage payment holidays. I mean, what levels of payment holiday requests have you seen, and what effect has it had on you operationally? I mean, David, if you want to pick that one up.
Yeah, I suppose because we're more at the specialist end, and we don't have a mixture of product lines. I mean, some of the really big lenders, they have a single service centre where it takes in residential calls and buy-to-let down the same telephone line. So they couldn't really pick and choose how they were able to approach it. Yeah. And of course, as a fairly new lender to market, our portfolio was that size as opposed to that size. So we could actually pick up directly with all of those landlords. And when we spoke to a quarter of them and said, have you spoken to your tenant, and is your tenant in trouble? They went, Oh no, I read it in the Sunday press, normally a certain well-known tabloid. We said, yeah, this isn't some form of entitlement, and there will be repercussions for this. Not only will it cost you money, but lenders may get a little bit grumpy with you down the line. So actually 26.2% shuffled off at that point. And we actually took in 80% of the requests in the month of April, and we've only had about 4 or 5% in May. Now, whether there's a resurgence of requests as the new rules come into play from today, I'm not sure. But once we've spoken to many landlords, we picked out the ones that genuinely either had a need for themselves or their tenants were in need, and we've been able to support them. But quite a lot of people, once they thought it through, and indeed, here we would like to thank, I'm sure Adrian would echo this, that landlord forums and broker networks and large brokers like MFB have been very quick to say to landlords, this isn't a free party and this could have consequences. Now, I appreciate it was too late for some, but I think the responsibility that people have shown in getting the right message out, because it was a bit mixed from government, and there's much that government could have done better and indeed should have done better, but this is one area where I think probably forbearance on buy-to-let, and I do try to avoid using the word holidays because that sends all sorts of wrong messages. Forbearance on buy-to-let isn't as high as homeowners, and indeed landlords should do their jolly best to get off it as quickly as possible.
I totally agree. I mean, as you know, I've been spending probably the last couple of months trying to advise landlords to avoid payment holidays if they can. I mean, clearly, if there's some in financial distress, then it might be the right call. But yeah, I don't think they've really thought through the consequences further down the line. I mean, Adrian, I guess a lot of yours is sort of a residential along with buy-to-let within the group.
Yeah, there's a mixture of residential and buy-to-let. I think it's in the public domain that we were just under 27% of our clients applied for payment holidays, and you know, we had to build a process at the start of that. It was a new thing. It came around very quickly. I think David would acknowledge that. And there was almost like a rush for applications there. We've now built if you like, almost an online process to deal with those requests. I've spoken to you several times, Steve, over the last 10, 11 weeks and various other people in the broking community. And I think as we've gone along that journey, landlords have become more clear of the implications that, you know, actually, in theory, this could cost money because it is a deferral, if you like, of payment. David used the word holiday earlier, which I think is probably where some of the confusion came in the way it was named. You know, I think we're in a lot clearer place with that now. I think landlords have a greater understanding. And I think actually the role of which the mortgage broker plays in advising them about that and I guess expressing more of the detail has become more prevalent over the last 5 or 6 weeks for me.
Yeah, because I think right at the beginning, the headline was that it wouldn't affect their credit profile if they took a payment holiday. And I suppose technically that's correct. But do you think those that have taken holidays will be treated differently when applying for finance in the future?
No, I think the bit was it was almost a how was it going to be registered on your credit file, Steve? And it wasn't going to be registered, I guess, adversely on there. I think, look, you know, as lenders, we have a duty to be lending responsibly. I think from a landlord's point of view, there are probably going to be more questions around over the next few months as we work through this in terms of have you taken a payment holiday? More lenders will probably ask for bank statements to see evidence of payments going in and out, for example. On there, I would expect that to happen more often. And bear in mind, you know, when the PRA rules came in, and David and I spent quite a lot of time discussing these, and yourself, Steve, a few years ago, for those landlords that fall into the additional underwriting category, obviously the majority of lenders that specialise in that space ask for a cash flow forecast and perhaps a business plan. And that has obviously got an element of backing up the story and whether or not they can cope with voids. So I think, you know, we're in the early stages of sort of as we work through this process. I think, you know, lenders will look for explanations, evidence, and perhaps probe more deeply into the application than they would have done going into COVID. I don't know if David agrees with me on that one.
Yeah, I think no one wants to write hard and fast rules for fear of being too tough on a genuine case where a landlord who perhaps has 3 properties and 2 of their tenants fell on hard times. You know, one works for an airline, one works for a catering company, and has lost 2/3 of their income. If they've taken mortgage payment holidays, that's a legitimate case that when they come to us for a remortgage and all they're looking to do is drive down their future costs, we would look very sympathetically at that. But then contrast that with someone who comes up today with a purchase and you ask them where the 25% deposit for the purchase comes from, and they source list one, bounce back loan, £50,000, source two, non-payment of my mortgages for 3 months across all of my lenders, yet I still receive my rent from my tenants. There's assuredly a place for that file, and it's underneath my desk with the dog shredding it before I get hold of it.
Yeah.
I don't want to try and make too many rules.
No.
And everyone will have a sensible view on this going forward, but trying to strike those rules at this juncture could only result in a negative approach.
Yeah. Sorry,
Steve.
I mean, I say the bounce back loans. I was going to come on to that next. I mean, I've seen headlines from OSB this week saying obviously you wouldn't consider that as a legitimate deposit use. I mean, as a broker, I'm come from the old school that you don't borrow your deposit anyway, and so I guess it just goes into that bucket. But,
and I think, Steve, we came out with clarity around that to give brokers guidance. As David said, the black and white hard and fast rules, the market is moving quite quickly at the moment. So, we wanted to give a steer to our broker and our landlord clients on that, because people have been asking the questions around that. I think the beauty of the buy-to-let market in which we play, which Keystone play, for example, is that we look at things on a case-by-case basis. We have, if you want to call them old school or very experienced underwriters who can look at the bigger picture. They will, and I fully expect them to ask more questions, as I said, around, I guess, the liquidity and the overall ability to cover voids in the portfolio going forward.
Yeah. I'm just finishing the point off on MPH. So it's been extended for potentially another 3 months. I saw Nationwide came out now sort of saying that it should start affecting their credit profile. And you agree with that?
Look, I don't think you can undo the rules when they came out at the start, and the rules were there to say to, I can't quote for another lender, but were there to say this wouldn't affect your credit file.
Yeah.
And I think as lenders, all we're looking to do is protect the lending, lend responsibly, and actually, speak to the client and get a greater knowledge of why they may have taken a payment break, for example, payment holiday.
Yeah.
So I think, we've got to be guided by what the original rules were when this came out. We've got to be sensible as lenders in our approach, but do expect more questions for landlords and ask for more reasons behind that.
Yeah. Good. Thank you.
Steve, I think the guidance that UK Finance put to the regulator, which hopefully made it into the press eventually, was that particularly in the buy-to-let sector, as you go into phase 2, lenders should reach out to the landlords and say, come on, genuinely, on that property for the avenue where you've asked us to give forbearance, is your tenant in trouble? And if they're not, we would really like you to come off the drug now.
Yeah, no, it makes a lot of sense.
And for all the reasons that Adrian's already mentioned, there is the roll-up cost of the interest on top, but there is now a bit more pressure being exerted on buy-to-let, because it has never been and never will be the same as a homeowner loan. It is a business decision. It is a business venture the customer is involved in. And we're now saying to them, we're probably going to ask you to tell us a bit more about these.
Yeah.
And if it's right, we'll continue with it. Or indeed, if you've fallen into it in the last few weeks, we'll talk to you about it. But this is for the very few that would engage with us on a sense of entitlement, we're saying, well, that sense of entitlement has gone even in the government guidelines, and I'm afraid we won't be granting it to you.
And I think if we put this logically, the vast majority of buy-to-let landlords seek advice from their advisors, such as Mortgages for Business. And I think as we've gone through the weeks, you've seen more landlords speak to their advisors about the implications and getting what I consider is the correct advice or the correct information about what the implications can be. Yeah. If you need to take those, and why you shouldn't in some circumstances be applying for them.
I agree. Let's move on to something more positive. You mentioned it earlier, Adrian, valuers back out. So can you tell us what you're seeing with regard to sort of turnaround times and the clearance of backlog? I know there's sort of a lot of you specialist buy-to-let lenders use the same valuation firm in Connells. So just wondered what the update was.
Look, I think they've done a good job in coming back. We have to remember their safety in this as well. There's slightly more rules about getting access to properties. We've also started to see the return of, David will be familiar with these, the long form valuations as well for the bigger properties. We've sent a message out recently to our broker parties, just asking for patience at this stage. I think we're only a few weeks in.
Yeah.
I would expect it to take a little bit of time. I think most landlords are patient with the situation. They appreciate it. Most brokers are. And us as lenders are working with all of our valuation partners to work through the backlog and indeed some of the new applications that are coming through at the moment. But we've tried to adopt working on a date-by-date basis and working through the backlog first so that people who have waited longer for their mortgage valuation and their application to proceed are dealt with in a straight date order. And I think that's the right way to do it at the moment.
Feels like end of June, early July for the backlog to be cleared?
I think they might get there sooner than that.
I was going to say that.
They've made really good strides. They only got the good to go on the 18th of May, and we're a fortnight in. And they had a big number on their desk to start off with because they had all those valuations that were backed up. And here's an organisation, without saying too much about their commercials, that were used to taking in upwards of 1,500 a day.
Wow, yeah.
So they had all that lot to clear. And then, of course, in each of our factories, we've been assembling a few, not as many as 1,500 a day. So these are all landing on their desks. So as Adrian says, they're going to go through them in batting order, unless there's a really genuinely exceptional pressing need. But here's an organisation that used to turn around valuations on an average of 3 days. And so we've got to cut them a bit of slack now. Their valuers have got to negotiate with a homeowner or a tenant or a landlord to go to a property. So they have to park up outside. Then they have to fully PPE up. Then they have to see that the landlord's going to walk down the road for 20 minutes whilst they do the property. This job is not the same job as they used to do. And thankfully it's a bit cooler outside today. But for the last 2 weeks, it's been 23 to 26 degrees in every point south of the Watford Gap. So, the guys have been finding it quite hard work. So I think by and large, we started off, and I think, Adrian, you sent the same message, say, you should allow 3 to 4 weeks for valuations to take place. If I was saying that message this Friday, I'm going to say 10 to 12 days, but you might get lucky in a postcode area where there isn't a backlog, and you may find it coming back in 3 to 4 days. And it doesn't mean they're not doing a damn good job. It's just that you can't unilaterally apply a single metric across the whole of the United Kingdom. So I think they've done a good job. And on the long form reports, the specialist firm that we use, funny enough, are almost quicker off the mark, and they're right on top of it. So, well done the valuers. They're out there. It's not the same norm. It's a new norm. But in the process, a transaction from start to finish is measured not in weeks but in months. Whether the valuers get to it in 3 days or 8 days or 9 days isn't a killer.
Yeah. But are you expecting a raft of down valuations, though, in the current climate?
I think a credit risk person would tell you they're an accurate market appraisal, Steve, rather than a down valuation. So look, I think we're seeing the early reports come back in. It's very difficult with transactions over the period where there's been a gap. And we're only just starting to get those reports back now. So I haven't seen too much evidence of it. I don't know if that would be the case from you or David. So, but I think to echo what David said before, we need to give our surveying partners a pat on the back at the moment because they've got back to it quickly. They're working hard with it, and it's not the easiest environment to have comparables over a recent period of time either.
Yeah. So that information is going to come out over the next 2 or 3 weeks, isn't it? So we'll keep. Yeah,
I think their guidance thus far, Steve, is they will refer to evidential data, which will probably, as Adrian say, predate it.
Yeah.
The RICS has directed all valuers to insert a standard health and warning clause, but Connells feel confident that in the high density areas of the big cities, they'll be able to take that off fairly quickly and start reporting live data. Anecdotally, they're starting to tell us about sold subject to contract, which in a formal world is the first thing you would totally ignore because it's not a done deal.
Yeah.
But for that evidence gap that you've just mentioned, it's a guide that either gives us confidence or gives us some extra tonality. So I think that, as Adrian says, the jury's still out. We track the data coming back in daily, but as you would know, a statistical sample only has validity when you have a good number of valuations behind it. And none of us are at that point with having enough data to start saying, well, it was analytically 2% marked down historically. Is it now 3.5%? There'll be people giving lots of sound bites on what it should or shouldn't be. I think I join Adrian. Let's just wait and see.
Yeah, wise words. So again, conscious of time, so I'll finish off with a couple of questions, and then we'll call it a day. But the penultimate question is really around interest rates. Now, we get a lot of calls from landlords saying base rates obviously down to almost zero, yet lenders seem to be increasing rates. And I know both Kent Reliance, Precise, and Keystone have recently increased mortgage products. Can you help me explain to landlords why that's happened? I mean, maybe Adrian, you can pick that one up first.
Yeah, look, we've still got to manage capacity, Steve, and we're still trying to work out what the new normal is at the moment. Obviously, fixed rates anyway aren't linked to base rate in the main, and predominantly landlords, or the offering we've got is around 2 and 5 year fixed rates. But we still have an awful lot of our workforce working remotely. When the moment's right, we want to get them back into the office and get them back into it safely. And actually, trying to work out what the flow of new business was going to be on those rates is, you're going out there with almost a bit of a guess. But I think there's a little bit of that's there to manage capacity, but there's also an element of pricing for risk. We've just talked about house prices. We're still to wait to see what happens there. And also, what is going to happen to landlords, tenants and profiles along the journey over the next few months, as we see people either potentially coming off furlough, what's going to happen with the jobs market. So I think these rates are there. I still think they're good value, to be honest with you. I don't think anyone can turn around and look at the rates in the market. We've been around a long time, the three of us, and we've seen rates certainly more expensive than what are out there at the moment. So I think part of it's about managing capacity. Part of it is that you're seeing the competition or the rates all being around the same amount at the moment as people look to see what the market's going to look like going forward for the short to medium term.
And David, are you driven by also what other lenders are doing in the market, when you're looking at your pricing?
Yeah, because I think like Adrian, we're all working remotely. So if I found myself at the top of the flagpole, we would just get in too much work, and we wouldn't be able to support anyone. We'd just go under. Technology is wonderful, but it's not the sole substitute for how you run a total business. But there was plenty of commentary as we came into late 2019 and early 2020 that competition had driven the pricing down too low.
Yeah.
Less so in our sector, but certainly so in the mainstream residential sector. Yeah. And there was a lot of muttering. Well, how do we come away from all of this? And you would say that some lenders, and I know OneSavings Bank would never do it, and I'd never do it, but some lenders were lending almost on vanity.
Yeah.
And whichever way you stacked your spreadsheet and shook it, they couldn't have been making money. So this is coming together, as Adrian said, with risk and with capacity, and a little less competition, as people say. Everyone's had a great time from the second half of 2019 and the opening months of 2020. Is this now stabilizing out? And the underlying swap rates aren't following bank base rate down. They've come back up a bit. They're saying at the end of this, there's going to be a new norm. If you're taking a 5-year rate, this is looking out not over the next 12 months, it's looking over 60 months. So as Adrian says, still to see 75% loan to value 5-year fixes in the mid to high threes is actually where we were about a year ago.
Yeah.
So will competition drive it back down before the end of this year? I don't get the sense. Ask Adrian and I this question again next spring. You may well find as a real margin it's come down, but then the underlying cost might have gone up.
Yeah.
So who knows when is the best time to strike? But a 5-year rate in the mid threes, when your yields are no doubt going to improve, because if prices come off the top and rental demand remains high, your yield that was stuck at 5 might go to 5.5%. And if you're leveraging off money from Adrian or us in the mid to high threes, that looks a pretty slam dunk business equation to me.
And I think, look, that there's some positive outlooks for landlords as well, because you might find people who were potentially looking to get onto the housing market, delaying that decision and looking to continue in the private rental sector for a period of time. So, back to the point, I still think that the rates and the products you see out there offer good value for money. And I think you'll still see landlords look at them and think that's a good deal to take.
Yeah, which leads nicely on to the crystal ball question on the outlook for specialist buy-to-let over the next sort of 12, 18 months. I know we've touched upon in there about sort of pricing, but how do you see the wider buy-to-let market to finish off today? David, your view on how it's set fair for landlords? I mean, my opinion is I think landlords should stick to it, and I think there's great opportunities for them.
Well, they've certainly had to absorb more than their fair share of knocks over the last 4 years on a political and taxation front.
Yeah.
So if they've got this far and they're well established, I think sadly there'll be some people who have to sell houses in the next year because of their overall employment basis. So landlords will be able to pick up properties quite readily. Some of our first-time buyers, the millennials, won't be in a position to buy, so landlords may be able to buy well. And I think, if money remains where it is for a period of time and the rents remain strong, in fact improve, it's a good model for landlords. The only question I have, and really yet to get to the bottom of it, is for those of us who sit on HMOs, how willingly are tenants and HMOs going to be wishing to occupy those properties where they share central facilities in a continuing concern about future waves of a virus to which we don't yet have a vaccine or regular medicine antidote. So there's lots of questions to think about on HMOs, but the mainstream buy-to-let market with ordinary flats and houses and bungalows, I would have thought it may wobble for a month or two as mixed messages come out, but I can see in a year's time it will look relatively the same as it does today.
You'd agree with that, Adrian?
No, I think buy-to-let is still a good investment. There's still good returns to be made. As David said, it is an investment. And if an investment isn't working, people can always change their investment strategy, and that might be around changing the type of property they want to buy or invest in. I also think it's interesting. We're coming out of this or sort of 12 weeks into where we are today. This is very different to the last downturn in terms of lenders having liquidity and money to lend and wanting to lend. So there is finance there for landlords. And I think the interesting bit is that if you look back to perhaps 08 or 09, what we didn't see then was an abundance of landlords getting rid of their investments. And I don't think you'll see that now. And I think, to David's point, there could be some opportunities in terms of properties coming onto the market that landlords wish to purchase or wish to use to further their investment. So, I keep using this, say, cautiously optimistic, I think is the way I would put it.
Excellent. And I think that's a great note to leave it on. Thanks, both of you, gents, for giving up your time today. I really appreciate it. I wish you both all the best for steering the businesses through to the other end of this, whatever the new normal looks like. But thanks again, and I'll see you both soon.
Thanks, Steve.
Thank you.
Cheers, Adrian.
Cheers.